Dear student, in this video, I'm trying to explain the meaning of funds, flow of funds, and fund flow statement. Let us start with the introduction about the topic. It is a very useful tool in the hands of the management for judging the financial and operating performance of the company. Here, for judging the financial and operating performance of the company usually use the fund flow statement. Here, a fund flow statement is to explain the changes in the working capital position of a company. Here, this statement explains the changes of working capital position in the company. Next topic is meaning of fund. Here, in narrow sense, fund means cash only. In a narrow sense, funds means cash only. So, in broader sense, funds means money value in any form that is exist in the business enterprises. That is men, material, machinery, methods. So, these are collectively called as money value of the business enterprises is called as a funds. In popular sense, funds refers to working capital. Here, working capital means excess of current assets over the current liabilities. The formula for working capital is working capital is equal to current assets minus current liabilities. Next, meaning of the term is flow of funds. A flow of funds. Flow of fund means movement of funds. That is inflow and outflow. In other words, flow of fund means transfer of economic value from one asset of equity to another or vice versa is called as flow of funds. According to working capital concept, the term flow of funds means movement of fund in working capital. It means if a transaction results in increase in working capital, it is called as sources or inflow of funds to the business enterprises. Suppose if the transaction results in a decrease in working capital, it is called as outflow of fund or application or uses of funds in the business enterprises. Here inflow means it is a return to the business. Outflow means it is an expenditure. Next, what is current assets? Here, current assets are those assets which can be converted into cash within a short period of time. Normally, one accounting year is called as current assets. Next, current liabilities. Current liabilities are those liabilities which are intended to be paid in the ordinary course of business within a short period of time. Normally, one accounting year is called as current liabilities. Here, for the purpose of computing the net increase in working capital or net decrease in working capital in case of fund flow statement, here the assets and liabilities are classified into two concepts. One is current assets and current liability. Another one is non-current assets and non-current liabilities. For computing the fund flow statement, here the assets and liabilities are classified into one is current assets and non-current assets, and another one is current liabilities and non-current liabilities. Here, take for example, for current assets, cash in hand, cash at bank, bills, receivables, sundry debtors, stock or inventory, short term investment, prepaid expenses, work in progress, outstanding or accrued incomes, other current assets, temporary or marketable investment. So these are comes under current assets category. And other part is current liability, that is list of current liability. Examples for current liability: take for example bills payable or accounts payable, sundry creditor, outstanding or accrued expenses, income received in advance, bank overdraft, dividends payable, short term loans and advances, provision against current assets, proposed dividend, provision for taxation. So these are comes under the category of current liabilities. Next is list of non-current assets. Take for example land and building, plant and machinery, furniture and fittings, trademark, patents rights, goodwill, long-term investment, debit balance of P&L account, discount on issue of shares, discount on issue of debenture, preliminary expenses, other deferred expenses. These are comes under the category of list of non-current assets. Then list of non-current liabilities are equity or preferential capital, debentures, long-term loans, share premium account, capital redemption reserve, depreciation on fixed assets, capital reserve, share forfeited account, credit balance of P&L account, appropriation of profit. Take for example general reserve, dividend equalization fund, sinking fund, compensation fund, insurance fund, investment fluctuation fund, provision for taxation, proposed dividend. These are comes under the category of list of non-current liabilities. The next topic is procedure for knowing the whether results in flow of funds or not. Procedure for knowing the whether the results in flow of funds or not. The first procedure is analyze the transaction and find out the two accounts involved. First, we read the transaction and after that we are find out whether the two accounts are involved in that transaction or not. This is the first procedure for knowing the results of flow of funds or not. Second one is make journal entry for that. Make journal entry for that. The next procedure is write the journal entry for the above transaction. Third one is determine whether the accounts involved in transaction are current or non-current. After making the journal entry, next procedure is determine the transaction whether the current or non-current. Fourth one is if both are current accounts, it does not result in flow of funds. Suppose in the transaction, both the transactions are current accounts, it does not result in flow of funds. Fifth one, if both are non-current accounts, once again, it does not result in flow of funds. Again, if both the transactions are non-current items, again it does not result in flow of funds. Sixth and last one is if the accounts involved in transaction one is current and another one is non-current, then the result in flow of funds. Suppose in the transaction, one transaction is a current item and another transaction is a non-current item, then it is said to be flow of funds. Here, the one major concept you should remember that is proposed dividend and provision for taxation treated as current as well as non-current item. Here the proposed dividend and provision for taxation can be treated as current liability as well as non-current liability. The next topic is following are the transaction do not result in flow of funds. The first one is cash collected from debtors. Here, what entry we are passed for cash collected from debtors? Cash account debtor to debtors account. Here, cash is an current item. Debtor is also a current item. Then the result is it does not affect the working capital. Second one is cash paid to creditors. What entry we are passed? Cash account debtor to creditor account. Once again, it does not result in flow of fund. Third one is BR realized. What entry we are passed for this one? Cash account debtor to bills receivable account. Once again, which do not affect the working capital. Fourth one is payment of bills payable. Once again, bills payable account debtor to cash account. Bills payable is a current item and cash account is also a current item. Once again, it does not result in flow of fund. Similarly, purchase of fixed assets in exchange of shares or debentures or long-term loans. For example, purchase for fixed assets in exchange of shares. What entry we are passed that? Fixed assets account debtor to share capital account. Fixed assets is a non-current item. One second, share capital is also a non-current item. One second, which is does not affect the working capital. So similarly, writing of fictitious assets, goodwill, accumulated profit, etc. like that. Seventh one is goods purchased on credit. Goods purchased on credit. For example, goods purchased from Mohan. What entry we are passed that? Purchase account debtor to Mohan account. Purchase is a non-current item. Mohan is also a non-current item. One second, it does not flow in the fund. Then payment of bonus in the form of shares. So in these cases or in this transaction which does not result in flow of funds. The next topic is following are the transaction results in flow of funds. The first one is issue of shares or debenture for cash. What entry we are passed that? Cash account debtor to debenture account. Issue of debenture. ಏನು ಎಂಟ್ರಿ ಪಾಸ್ ಮಾಡ್ತೀವಿ? ಕ್ಯಾಶ್ ಅಕೌಂಟ್ ಡೇಟಾ ಟು ಡಿಬೆಂಚರ್ ಅಕೌಂಟ್. ಇಲ್ಲಿ ಕ್ಯಾಶ್ ಅನ್ನೋದು ಕರೆಂಟ್ ಅಸೆಟ್, ಡಿಬೆಂಚರ್ ಅನ್ನೋದು ನಾನ್ ಕರೆಂಟ್ ಲಯಬಿಲಿಟಿ. ಒಂದು ಕರೆಂಟ್ ಇನ್ನೊಂದು ನಾನ್ ಕರೆಂಟ್. ಹಾಗಾದರೆ ಏನಾಗುತ್ತೆ? ಫ್ಲೋ ಆಫ್ ಫಂಡ್ಸ್ ಆಗುತ್ತೆ. ಅದೇ ಥರ ಎರಡನೇದು ಬಾರೋಯಿಂಗ್ ಆಫ್ ಲಾಂಗ್ ಟರ್ಮ್ ಲೋನ್ಸ್. ಇದರಲ್ಲೂ ಅಷ್ಟೇ ಫ್ಲೋ ಆಫ್ ಫಂಡ್ ಆಗುತ್ತೆ. ನೆಕ್ಸ್ಟ್ ಸೇಲ್ ಆಫ್ ಇನ್ವೆಸ್ಟ್ಮೆಂಟ್ ಆರ್ ಫಿಕ್ಸ್ಡ್ ಅಸೆಟ್ಸ್ ಫಾರ್ ಕ್ಯಾಶ್ ಆರ್ ಆನ್ ಕ್ರೆಡಿಟ್. ಒಂದು ಸೆಕೆಂಡ್ ಏನಾಗುತ್ತೆ? ಫ್ಲೋ ಆಫ್ ಫಂಡ್ ಆಗುತ್ತೆ. ಪರ್ಚೇಸ್ ಆಫ್ ಫಿಕ್ಸ್ಡ್ ಅಸೆಟ್ಸ್ ಫಾರ್ ಕ್ಯಾಶ್. ಫಿಕ್ಸ್ಡ್ ಅಸೆಟ್ಸ್ ಅಕೌಂಟ್ ಡೇಟಾ ಟು ಕ್ಯಾಶ್ ಅಕೌಂಟ್. ಫಿಕ್ಸ್ಡ್ ಅಸೆಟ್ಸ್ ಅನ್ನೋದು ನಾನ್ ಕರೆಂಟ್ ಐಟಮು, ಕ್ಯಾಶ್ ಅನ್ನೋದು ಕರೆಂಟ್ ಐಟಮು. ಒಂದು ಸೆಕೆಂಡ್ ಏನಾಗುತ್ತೆ? ಫ್ಲೋ ಆಫ್ ಫಂಡ್ ಆಗುತ್ತೆ. ಬೋನಸ್ ಪೇಯ್ಡ್ ಇನ್ ಕ್ಯಾಶ್. ಸಿಕ್ಸ್ತ್ ಒನ್ ರೀಪೇಮೆಂಟ್ ಆಫ್ ಲಾಂಗ್ ಟರ್ಮ್ ಲೋನ್ಸ್. ಸೊ ಈ ಕೇಸಲ್ಲೆಲ್ಲ ಏನಾಗುತ್ತೆ? ಫ್ಲೋ ಆಫ್ ಫಂಡ್ ಆಗುತ್ತೆ. ಆ್ಯಂಡ್ ದ ಲಾಸ್ಟ್ concept is meaning of fund flow statement. Here fund flow statement which indicates the various means by which funds are obtained and how the funds have been used during a given period of time. Here it is also called as statement of inflow and outflow of funds or sources and application of funds is called as fund flow statement. The next topic is difference between fund flow statement and income statement and advantages and limitations of fund flow statement. Let us start with the difference between fund flow statement and income statement. So in case of fund flow statement shows inflow and outflow of funds. But income statement shows only incomes and expenditures of the business enterprises. This is the first difference. Second one is fund flow statement is prepared with the help of income statement. Here, the fund flow statement is prepared based on the help of the income statement. Here, in case of income statement is prepared with the help of trial balance. Here, with the help of trial balance, income statements can be prepared. The third difference is fund flow statement includes capital and revenue items. Here, in case of fund flow statement, preparation of fund flow statement, it includes capital and revenue items. But in case of income statement, it includes only the revenue items. Next, fourth difference. So in case of fund flow statement, there is no fixed format for preparation of fund flow statement. But in case of income statement, we have to need fixed format for the preparation of income statement. The last difference is a fund flow statement shows the changes in the financial position of a business between beginning and ending financial statement dates. But in case of income statement, it shows the net profit of the business. These are the difference between fund flow statement and income statement. The next topic is uses or significance or advantages of fund flow statement. Here, the important advantages of fund flow statement is the first one is fund flow statement is an important tool of financial analysis. So here, the fund flow statement is also the one of the major tool and technique of financial statement analysis. Second one is fund flow statement helps to take decision relation to many issues concerned with funds. Here, the fund flow statement helps to business enterprises regarding decision making, especially in connection with the funds of the business enterprises. The third advantage is fund flow statement helps in proper allocation of funds. And fourth one is the fund flow statement act as a future guide. So the fund flow statement act as a future guide for the business enterprises. The next advantages is fund flow statement helps to judge the credit worthiness of the firm. Here the fund flow statement judge the worthiness of the business enterprises. The last advantages of fund flow statement is fund flow statement helps in financial planning and preparation of budgets. Here, the fund flow statement also helps the business enterprises in case of financial planning and preparation of budget. These are the advantages of fund flow statement. Next, the drawbacks or limitations of fund flow statement. Here, the first drawback or limitations of a fund flow statement is the first one is fund flow statement is not a substitute of an income statement or balance sheet. Here, the fund flow statement is different from income statement and balance sheet. It is not a substitute for balance sheet and income statement. This is the first drawback of fund flow statement. The second drawback is the fund flow statement cannot reveal the continuous changes. Here, suppose we run the business means we need some modifications in the business. So in this regard, the fund flow statement cannot reveal the continuous changes in the business enterprises. The third drawback or limitations of fund flow statement is the fund flow statement is not an original statement. So the fund flow statement is not a true statement for the business enterprises. From the fund flow statement, we cannot judge the financial position of the business enterprises. The fourth drawback or limitations of fund flow statement is The fund flow statement is not successful compared to cash flow statement. When we are comparing cash flow statement, fund flow statement is not successful. Here the cash flow statement reveals the exact cash financial position of the business enterprises, because we are prepare the cash flow statement as per the accounting standard 3. And the last drawback or limitations of fund flow statement is the fund flow statement is historic in nature. So here these are the drawbacks or limitations of fund flow statement. Thank you for watching this video.